Are you looking to move to Dallas and you're thinking about buying a place and you're considering not buying a house, not buying a townhouse, but buying a condo, but you're wondering what the pros and the cons are? Stick around. This video is for you. Hey, what's up everybody? It's your mortgage expert, Brian McCauley. So listen, the housing market in Dallas, Texas is just running wild. There is less inventory than ever, so a lot of people are starting to consider buying condominiums. Condos are a really good thing to buy. There are a couple things that I want to cover in this video if you're potentially going to buy a condo that I want you to be aware of. There are some pros, there are some cons, so let's start with the pros first. Condos themselves are lower maintenance, right? They don't have yards. A lot of times the HOA community will take care of everything for you, so there's less maintenance. Another pro is they're a lot cheaper. You're getting an actual condo unit and just the space versus like actual land versus a yard, and so the cost for the actual unit itself is much less than like a single family or a townhome. Let's talk a little bit about the negative components of condo. I'm gonna start with condos in general, and then we're gonna talk about mortgage guidelines, how they're a little bit more particular and specific around condos. Couple negative things about condos just in general. Number one, they're attached property. You're attached to a huge community, your neighbor's right next to you, so there could be a noise factor there. Second thing about condos is what your neighbor does affects you a lot more. So whether they keep it clean, whether they keep it dirty, whether they rehab it, all of these things matter when you're buying into a huge condominium project because you're so closely located to all the neighbors, to all the common amenities. Everything that everybody does affects you more and affects your unit more versus if you buy a house, you're standalone all by yourself, so what your neighbor does doesn't matter as much. You want to make sure that you are buying a condo in a community that is clean and on the up and up and making sure that there's no big surprises behind the scenes. So if you're considering a condo, these are a couple things to look at. I want to lean into and switch gears for a minute regarding mortgages and home loan finance around condos, because here's really where the big difference is, what a lot of people don't know and sometimes realtors don't even know, and clients will get under contract and find out some of this bad news after the fact. When a lender is giving a home loan, there's two major things that they pay attention to: the person and the property, okay? When you're buying a house, all the lender really cares about is the value of the house and the condition of the house. When you're buying a townhome, the lender just really cares about the value of the townhome and the condition of the townhome. However, when you're buying a condo, here's the big one. They care about the value of the condo, they care about the condition of the condo unit, but more importantly, they care a ton about the condo complex in its entirety. Why? Because you're buying into a huge community and they want to know what's going on with the community. Even if the buyer has great credentials, even if the unit they're buying is a great unit, a clean unit, the value is there, they want to know what's going on with all the other condos because everything is attached. And so if there's some problems with that project, they want to know about it. Number one, to protect the buyer's investment. Number two, to protect the mortgage company's investment to make sure there won't be any issues after the fact. So the first thing, first and foremost, is we want to know, are there more homeowners than renters in the project? So there needs to be at least 51% of homeowners in the project versus renters. Why? Well, historically, homeowners take better care of their place than renters. So they don't want your unit to be a great unit, but the rest of the condo be run down by renters, and it could potentially cause issues with the value and cause it to decline over the years, and they don't want that for you. So the first thing they're checking is renters to owners. Second thing they're going to check, occupancy concentration of a single individual or an entity. Here's what I mean. They want to know, for example, if there's 100 condominium units in a condo complex, no one person or no one business can own more than 25% of the units. Why does that matter? Well, let's say I, Brian McCauley, owned 25 condominiums in a 100 condominium project, and I have a heart attack tomorrow and I die. And all those condos are mortgages. And my realtor, my family, whoever, is not able to sell those condos in time, and some of those end up foreclosing. Well, if 8 out of those 25 that I have end up foreclosing. What will that do to the value of the other condominiums in the project? It will bring them down. It can potentially bring down all the value of all the units, and they're trying to protect the homeowner on that. Second thing is, they don't want anybody manipulating the bylaws. Most condominiums have a homeowners association. The association usually has a board of people. Well, if you own 25% of the units, you're gonna get a lot more voting rights than the individuals that just own 1 or 2. You could potentially manipulate the bylaws, manipulate the voting rights to your favor, and vote for things that are in your favor only, not in the greater good and the best interest of the condo complex. The third thing is they want to make sure that there's no pending litigation. If the lawsuit ends up being in the favor of the homeowner, it can cause all kinds of problems with the insurance coverage, the HOA dues. If it does have something and you're trying to buy it, you either got to do it cash or go non-traditional financing, but on most home loans, it isn't allowed. Last thing they want to look at is the HOA budget. The HOA usually has some type of accountant or treasurer that's managing all the money to make sure that they've got enough money to pay for repairs, landscaping, all these things, right? So we care about the reserve budget in the HOAs because we want to make sure they have at least 10% reserves at all times. And so what the bank's trying to do is they're trying to make sure, hey, I want to make sure that your HOA budget is being run well and there's a heavy reserve in there. Because the last thing I want my client doing is buying into an HOA that doesn't budget their money right. 3 months later after they buy, they send everybody an update that says, hey, we're going to reassess the dues, and they raise it by $100 or $150. That matters a lot to some people, and we're trying to protect that. What happens if that person that they raise the dues on $100 or $150 honestly can't afford it? What happens? Well, they go into default. They can't pay what's now due, and then potentially the HOA can start to foreclose on that property. And if they foreclose on that property and they sell that property for less than market value, guess what? That brings the value of the other units down. So there are so many things on condos that as buyers, sometimes even agents, we don't know. Now you know all the things behind the scenes that are specific to condos that mortgage companies care about whenever they are giving financing for a person that's buying a condo. So I know that was a lot of information and it's a little bit confusing, but hopefully it was helpful to you. If you found it helpful, do me a favor, like, subscribe, comment on this video below. I promise to get back to you. If you've got any questions about your current situation, looking for a pre-approval, condo questions, or just anything housing, mortgage, financial related, do me a favor, call us, email us, text us, set up a consultation with me. I promise to take good care of you. Until next time, stay tuned.